Most people think silver crashed because of the market. But what if I told you this silver crash was not an accident? Not panic, not fear, but something far more calculated. What if the drop you just witnessed was engineered, timed, and executed with precision to force weak hands out, crush sentiment, and transfer real physical silver from the public into institutional control? Stay with me, because by the end of this video, you may never look at silver price charts the same way again. Right before the crash, silver was building momentum, technicals were improving, sentiment was turning bullish, and retail interest was quietly rising again. That's when everything suddenly reversed. No major breaking news, no global emergency, no surprise economic collapse. Just a violent sell-off that erased weeks of gains and hours. This wasn't normal price discovery, this was pressure. Before we go deeper, if you value honest market breakdowns and real talk about what's happening behind the scenes, hit the like button and subscribe right now. It helps the channel a lot and tells the algorithm you want more content like this from Silver Shockwave. Trust me, you'll want to stay connected for what's coming next. Now let's talk about how engineered crashes actually work, because this isn't the first time silver has been hit like this. Silver is not just a commodity. It's money, it's an industrial metal, and it's a strategic asset. And when silver starts moving too fast, too loud, or in the wrong direction for powerful players, pressure appears. Look closely at how the crash unfolded. Massive sell orders hit during low liquidity hours. Futures contracts dumped in bulk, not gradually. This wasn't someone slowly exiting a position. This was someone forcing the price down. When you dump thousands of paper contracts at once, you're not trying to get the best price. You're trying to move the market. As price falls, stop losses get triggered. Algorithms kick in, retail traders panic, social media fills with fear. Silver is dead. The rally is over. That emotional reaction is not a side effect, it's the goal. Fear is a weapon in financial markets, and it works every time. Ask yourself this question: if silver demand was truly collapsing, why are physical premiums still high? Why are mints reporting delays? Why do dealers keep warning about tight supply? Why does industrial demand keep rising year after year? The paper price says one thing. The physical market tells a very different story. This disconnect is the key. The silver price you see is mostly set by paper contracts, not by physical bars changing hands. That means price can be pushed down even when real-world demand is strong. And when price is pushed down artificially, it creates opportunity, just not for regular investors. Big players thrive on volatility. They don't panic sell, they wait. They let price drop. They let retail get shaken out. And then quietly, they accumulate. This is why engineered crashes often happen right before major moves higher. Weak hands sell at the bottom. Strong hands buy the fear. Notice the timing. Just as inflation concerns remain unresolved, just as debt levels hit record highs, just as geopolitical tensions continue to grow, just as industrial silver demand from solar, EVs, and tech keeps expanding. Does that really sound like the perfect environment for silver to naturally collapse? Another red flag is margin pressure. After sharp moves, exchanges often raise margin requirements. That forces leveraged traders to liquidate, even if they're right long term. Forced selling pushes prices lower, which triggers more liquidations. It's a chain reaction, and it's predictable. This is why price crashes feel sudden and violent. They're designed to overwhelm emotion. The average investor doesn't have time to analyze. They react, they hit sell. And that's exactly how transfer of wealth happens in markets. History backs this up. Silver has seen this pattern again and again. Sharp drops followed by long consolidation, then explosive upside moves that catch most people off guard. By the time headlines turn bullish again, the smart money is already positioned. And here's the part most people miss. Engineered doesn't mean illegal. It means strategic. It means using tools that already exist, leverage, liquidity, algorithms, timing, to influence behavior. Markets are psychological battlefields, and silver is one of the most emotional assets out there. If you zoom out, silver hasn't broken its long-term fundamentals. Global debt hasn't disappeared. Currency debasement hasn't stopped. Industrial demand hasn't slowed, physical supply hasn't suddenly surged. Only sentiment has collapsed, and sentiment is the easiest thing to manipulate. That's why moments like this matter. Not because price fell, but because of how and when it fell. Crashes reset narratives. They rewrite confidence. They convince people the story has changed even when it hasn't. At Silver Shockwave, we don't just watch price, we watch behavior, we watch volume, we watch timing, and what we're seeing right now looks less like a market failure and more like a setup. This doesn't mean price goes straight up tomorrow. It means volatility is doing its job. It means patience becomes an advantage. And it means emotional decisions are the most expensive ones you can make. If you've held through this, you're not crazy. If you felt confused, that's normal. Confusion is part of the process. Markets don't reward certainty, they reward discipline. Now I want to hear from you. Do you think this silver crash was natural, or do you believe it was engineered? Drop your thoughts in the comments below. I read every single one, and your perspective helps others understand what's really happening. If this video helped you see the silver market differently, share it with someone who's been shaken by the recent price action. Sometimes one clear explanation is all it takes to stop panic and start thinking long term. The silver market isn't broken, it's contested. And when something is this contested, every move matters. Stay sharp, stay informed, and stay connected. Because the next move often begins right when most people stop paying attention.